class 2A. Let's verify. Eligible SSE category 1, any SSE engaged in manufacturing, production or process of any article or thing. That means if he is engaged into the trading activities, not eligible for claiming additional depreciation under section 32 subsection 1 class 2A. Must be engaged into the manufacturing, production or process of any article or thing. Next ma, any SSE engaged into the generation or transmission or distribution of electricity covered under section 32 subsection 1 class 2. That means following block wise and claiming depreciation on double DV basis. That means in case that electricity generation SSE claiming depreciation under section 32 subsection 1 class 1, that means asset wise and straight line method, not eligible to claim additional depreciation, because already we are giving incremental depreciation. Again, we are not allowing double benefit of additional depreciation. So tell me, who is allowed in case of electricity generating SSE? Only the person who is claiming depreciation under section 32 subsection 1 class 2. That is block and double DV. Next ma, that means electricity company covered under section 32 subsection 1 class 1, that is asset wise and straight line method, not eligible. Good. Eligible plant and machinery. What is the eligible plant and machinery ma? New plant and machinery installed on or after 1/4/2015. What is eligible plant and machinery? Only new plant and machinery. Are you following? What is your first observation ma? The observation is only plant and machinery is eligible for claiming additional depreciation. That means intangible assets not eligible, building not eligible, furniture not eligible, only plant and machinery. That too new plant and machinery ma. That means second hand plant and machinery is not eligible, only new plant and machinery. What is the definition of new plant and machinery? I have provided here. What is the new plant and machinery ma? A plant and machinery which was not used earlier in India as well as outside India. It should not be used in India as well as outside India. That means it should be entirely new plant and machinery. That alone will be treated as new plant and machinery and eligible for claiming additional depreciation under section 32 subsection 1 class 2A. Why this section has been introduced in this class? To encourage the manufacturers to acquire what is that new plant and machineries, so that with less electricity consumption they can produce more materials, more products. Next ma. Understood? Next. Quantum of additional depreciation, the rate at which additional depreciation will be allowed to the eligible SSE is 20%. What is the rate of additional depreciation ma? 20%. Remember, important points, pay attention. In case of new plant and machinery put to use less than 180 days ma, same as above discussion, that new plant and machinery acquired in the current previous year put to use less than 180 days, then entire 20% of additional depreciation shall not be allowed. Half of that will be allowed. What do you mean by half of that? 50% of 20%. That means only 10% will be allowed in case put to use less than 180 days in the year in which it is acquired. Then 50% of 20% will be allowed. Half of 20% will be allowed. The balance will be allowed in the next previous year, inserted through Finance Act 2015, third proviso to section 32 subsection 1 class 2. Will explain. In case the new plant and machinery acquired in the current previous year and put to use for a period less than 180 days in the current previous year, then as per proviso 2, what is that? As per proviso 2 to section 32 subsection 1 class 2, only 50% of 20% rate will be eligible for claiming additional depreciation. Then remaining 50% shall be allowed in the next year. That is not at all allowed. No, it will be allowed when in the next year ma, under as per proviso 3. As per proviso 2 to restriction, as per proviso 3 allowing in the next year. That's it. The following plant and machinery not eligible to claim additional depreciation. List has been given. Let's verify. Second hand plant and machinery not eligible. Ships and aircrafts not eligible because they are not in the production process. Plant and machinery installed in the office premises or guest house of the employees not eligible, because if you want to get the eligibility for claiming additional depreciation, it must be installed in the factory premises, not office or guest houses. Other office appliances and road transport vehicles not eligible ma. The plant and machinery for which total cost is allowed as deduction or depreciation for the purpose of determining income chargeable to tax under the head PGBP in any previous, I will explain. specified business under section 35 AD. If you remember specified business section 35 AD, there 100% of eligible capital expenditure will be allowed as deduction in single year to encourage those specified businesses. They are not eligible for depreciation, they are eligible for deduction. What is the rate of deduction? 100% of eligible capital expenditure shall be allowed as a deduction in the single previous year under section 35 AD. That asset again not eligible for claiming additional depreciation under section 32 subsection 1 class 2A, because already we have given the huge benefit. That means 100% of expenditure has been allowed as deduction in single year. Again, we are not allowing additional depreciation. That is what we mean by the plant and machinery whose actual cost has been, entire actual cost has been allowed as depreciation or deduction in the single previous year. Then again, it is not eligible to claim additional depreciation under section 32 subsection 1 class 2A. Next illustration 1, let's verify. Mr. X provides the following information. Block 1, tangible plant and machinery 15%, opening double DV, plant and machinery A, B, C 10 lakhs. Mr. X purchased a plant and machinery called D on 15/6/2021 for 5 lakhs, and he sold plant and machinery B for 8 lakhs. Double DV of the plant and machinery B, which is transferred by Mr. X, is 2 lakhs That means the plant and machinery called B, which is having double DV of rupees 2 lakhs, has been transferred for 8 lakhs The double DV of the transferred plant and machinery is 2 lakhs, but that has been transferred for 8 lakhs. Tell me what we have to reduce while determining current year depreciation as well as closing double DV. We need to reduce sale proceeds We need to reduce sale proceeds, but not the double DV of the asset transferred. Why we have to reduce sale proceeds but not the double DV? Because out of the total investment made over the block of assets, some amount has been recovered through sale of one of the asset in that block Now the amount recovered will be treated as not invested over the block because it reached your pocket. Hence that amount recovered must be reduced, but not the double DV alone. The amount what you recovered upon transfer of that plant and machinery in that particular block alone shall be reduced, but not double DV, because that is recovered back to into our pocket. Then only net investment shall be considered. Are you following? Next Determine the depreciable value. Okay. Do you remember the format Opening double DV. Determination of depreciable value. Opening double DV as on 1/4/21, 10 lakhs. Add actual cost of additions. How much purchase of plant and machinery D on 15/6/21, 5 lakhs. Then sale proceeds, note 1, 8 lakhs. Entire 8 lakhs we have to consider. Then you will get depreciable value less current year depreciation. Note 1 Here we have to reduce the sale proceeds but not double DV of the assets sold. Since the sale proceeds on account of transfer of asset in the block is received back into the pocket, so that the net investment on the block will be reduced. Therefore, on such reduced net investment, we need to claim depreciation by treating it as depreciable value. Very good. Illustration 2 X Limited in Mumbai, engaged in the manufacturing business, acquired plant and machinery A. Date of acquisition 1/6/2021, that is in the previous year 21/22. Date of installation 15/6/21, that is previous year 21/22. Decide the year of allowance of additional depreciation and rate of additional depreciation under section 32 subsection class 2A. What is the year of allowance of additional depreciation Year of installation. Remember, merely purchase of new plant and machinery is not enough to claim additional depreciation. That must be installed. Then only the production capacity will be increased. Contribution to the GDP. Country's GDP. Are you following? So merely purchase is not enough. You have to install. Then only it will be eligible for claiming additional depreciation. So what is the answer for that question? Year of allowance year of installation. Tell me what is the year of installation? 15/6/2021. That means previous year 21/22. That year is eligible for claiming additional depreciation. And what is the rate we have to apply Put to is more than 180 days, right? Full 20% we have to apply. Let's verify. Year of allowance of additional depreciation under section 32 subsection 1 class 2A is year of installation, that equal to 21/22. The applicable rate of additional depreciation is 20% since proviso 2 to section 32 subsection 1 class 2 is not applicable. Why not applicable Put to is more than 180 days. as the plant and machinery is acquired in the current previous year and put to use for a period more than 180 days in the current previous year. Good. Therefore, eligible for normal rate of 20%. Next, ma. Y Limited provides the following information. Y Limited acquired plant and machinery B on 1/6/2021, that is in the previous year 21-22. The date of installation of such plant and machinery B is 15/2/2022. That means put to use less than 180 days. Ma. Decide the year of allowance of additional depreciation and rate of additional depreciation. What is year of allowance? 21-22, but 10% only because proviso 2 is applicable. In the present case, Y Limited installed the plant and machinery in the previous year 21-22. Therefore, year of allowance of additional depreciation equal to year of installation, that is previous year 21-22. The applicable additional depreciation rate is 20%, but here proviso 2 to section 32 subsection 1 class 2 is applicable since the plant and machinery is acquired in the previous year 21-22 and put to use for a period less than 180 days in the current previous year. Therefore, as per proviso 2 to section 32 subsection class 2, the additional depreciation will be allowed at 50% of 20%, that is 10%. Then balance 50% will be allowed in the next previous year 22-23 as per proviso 3 to section 32 subsection 1 class 2A. The balance 50% of additional depreciation which is not allowed in the previous year 21-22 will be allowed in the previous year 22-23 as per proviso 3 to section 32 subsection 1 class 2. Good. Next, my illustration 4. A Limited provides the following information. A Limited purchased a new plant and machinery D on 1/6/2021, that is in the previous year 21-22. The date of installation of such new plant and machinery D is on 15 February 2023. What is year of installation? 22-23. That means year of allowance is 22-23. Then in that year, whether it is put to use more than 180 days or less than 180 days, you are eligible to claim at full rate 20%, because the condition is applicable only in the year of acquisition. Decide the year of allowance and additional depreciation and rate of additional depreciation. Solution, year of allowance of additional depreciation is year of installation, that is previous year 22-23. The applicable rate of additional depreciation is 20%. Here proviso 2 to section 32 subsection 1 class 2 is not applicable in the previous year 22-23, even though it is put to used for less than 180 days since it was acquired in the earlier previous year 21-22. Therefore, the additional depreciation will be allowed at normal rate of 20%. Next, Z Limited provide the following information. Z Limited acquired a new plant and machinery on 1/6/2021, that is previous year 21-22. The date of installation of such new plant and machinery is on 15/6/2022, that is previous year 22-23. That means more than 180 days put to use. I already explained whether it is put to use more than 180 days or less than 180 days in the subsequent years other than the year of acquisition, full rate will be allowed. Year of allowance 22-23, applicable rate 20%. Here the plant and machinery acquired in the previous year 21-22 and installed in the previous year 22-23. In such case, irrespective of the period of put to use, whether it is less than or more than 180 days, the additional depreciation will be allowed at normal rates as per proviso 2 to section 32 subsection 1 class 2 is not applicable. Therefore, additional depreciation will be allowed at 20%. Next, unabsorbed depreciation, very important, pay attention. What is the dealing provision? Section 32 subsection 2. Remember the section number, Section 32 subsection 2 deals with unabsorbed depreciation. There are two possible cases where unabsorbed depreciation will arise. First one, there are no profits at all to claim the current year depreciation. There are no profits at all to claim the current year depreciation. Second case, there is a profit in the current year to claim the current year depreciation, but it is not what we can say, but the current year profit is not sufficient to claim entire current year depreciation. What is the first case, there are no profits at all to claim current year depreciation. Second case, there are profits, but those profits are not sufficient to claim entire current year depreciation. That means some part is remained unabsorbed, then that will be treated as unabsorbed depreciation under section 32 subsection 2. Let's verify. The following are the two cases where unabsorbed depreciation will arise. Case 1, there are no profits at all to claim current year depreciation. Case 2, there are profits, but those profits are not sufficient to absorb entire current year depreciation. Example 1, turnover 10 lakhs, expenses 8 lakhs, but current year depreciation 5 lakhs. Let's verify. Turnover 10 lakhs, expenses 8 lakhs, then profit before depreciation 2 lakhs, less current year depreciation 2 lakhs, then what is unabsorbed depreciation ma? 3 lakhs. 32 subsection 2 will be applicable. This is first case ma. Then example 2, turnover 10 lakhs, expenses 12 lakhs, current year depreciation 5 lakhs. Then turnover 10 lakhs excluding depreciation, what is the expenditure ma? 12 lakhs, then resulted into business loss of 2 lakhs. Then entire current year depreciation will be treated as unabsorbed depreciation under section 32 subsection 2. Now what is the treatment for unabsorbed depreciation under section 32 subsection 2 ma? It can be carry forward for unlimited period, very important. It can be carry forward for unlimited period and can be claimed against any head of income except income from salary. Remember, the unabsorbed depreciation can be carry forward for unlimited period and can be adjusted against any head of income except income from salary. Section 32 subsection 2. Next, very important point, pay attention. Apportionment of depreciation in case of succession or amalgamation or demerger. Fifth proviso to section 32 subsection 1. There is amalgamation, there is succession, there is demerger taken place in the current previous year. Then how to determine depreciation, and such determine depreciation, how to apportion between the two parties. What do you mean by two parties? In case of succession, successor and predecessor. In case of amalgamation, amalgamating company, amalgamated company. In case of demerger, demerged company, resulting company. Then how to apportion? First, how to determine depreciation. Second question, how to apportion such determined depreciation between two parties. Let's verify. In case there is succession of any partnership firm or proprietary concern by a company or amalgamation or demerger in the current previous year, then determine the depreciation in the current previous year, assuming there was no such succession, amalgamation or demerger taken place. What is the meaning? Assume no succession, amalgamation, demerger taken place in the current previous year. Determine depreciation by applying the relevant provisions but in the normal course, assuming no change occurred in the constitution of the organization. Considering that, assuming that, determine by following normal procedure. Determine the depreciation. Such determined depreciation shall be apportioned between the two parties depending upon the ratio of number of days for which such assets were used by them. Let's verify. In the current previous year, then we have to determine the depreciation for the current previous year as if there is no succession, amalgamation or demerger took place in the current previous year. Then the determined depreciation shall be apportioned between predecessor and successor in case of succession, amalgamating company and amalgamated company in case of amalgamation, demerged company and resulting company in case of demerger, in the ratio of, this is important this is important, in the ratio of number of days for which such assets were used by them. Okay, that is the pura discussion relating to what? Depreciation under section 32. That we need to reduce depreciation as per Income Tax Act. We need to reduce. Next payments made by the, next we need to reduce payments. We are verifying format. Pay attention. Pro forma. Payments made by the assessee in the current previous year which are covered under section 43B. You know, in case the payments has not been made in the within the due date, then as per section 43B, it was disallowed in the earlier previous year. Now the payment has been made, then in the current previous year it will be allowed as a deduction. You need to reduce. Next third part. Incomes taxable under other heads of income or exempted income which are credited to the P&L account. Other heads of income, exempted income credited to the P&L account, we need to, what we need to do? Less from the net profit, because those incomes included in the net profit we need to reduce. Less. Short term or long term credited to the P&L account, you need to less, because that shall be under the head capital gain. Salary received shall be under the head income from salary, you have to reduce from net profit. Winnings under section 115BB must be under the head IFOS, you need to less. Commission received IFOS, you need to less. Honorarium IFOS, less. Refund of income tax principal amount. At the time of making the payment of income tax, deduction not allowed. Then at the time of refund also not taxable. Remember, at the time of making the payment of income tax, deduction not allowed because we treated it as personal expenditure. Then at the time of refund also not taxable. If at all the refund of income tax credited to the P&L account, you need to less. Next Interest on income tax refund, that shall be taxable under the head IFOS. You need to reduce from net profit. Refund of income tax penalty ma, because penalties are not allowed as deduction. In case any refund is coming, that must be reduced, should not be included in the net profit because it is not taxable. Bad debts recovered ma, bad debts recovered at the time of incurrence of bad debts, not allowed as deduction. If at all at the time of incurrence of deduction, incurrence of bad debts, deduction was not allowed, means included in the business income, already taxed. Now at the time of recovery, again you included in the net profit, again you are charging to tax, means you are charging twice ma. Therefore, any bad debts recovered which was not allowed as deduction earlier and created to the P&L account in the current previous year, that shall not be chargeable to tax because already taxed. Then you need to reduce from the net profit. What if it was allowed as deduction in the earlier previous year ma? In case it was allowed as deduction in the earlier previous year, then in the year of recovery it will be chargeable to tax. No adjustment is required. It can be credited to the P&L account. It will be taxable under the head PGBP only. It can include in the net profit. So when we have to less ma, only when that bad debts recovered was not allowed as deduction in the earlier previous years. Next ma, dividend from domestic company, taxable under the head IFOS. You need to reduce from net profit. Dividend income, dividend or income from unit exempt under 1035, exempted income, not chargeable to tax at all, but included in the net profit because credited to the P&L account. You need to reduce. Agricultural income, exempted income, reduce. Long-term capital gain covered under section 1128, taxable under capital gain, reduce. Interest on government securities, IFOS, reduce. Gift, taxable under IFOS, reduce. Share income from partnership firm, exempt under section 10 subsection 2A, reduce. Next ma, share income from HEF, exempt under section 10 subsection 2, because HEF already paid tax but credited to the P&L account, included in the net profit, reduce. Next ma, fourth part, other adjustments. Closing stock, in case in the examination they have given that closing stock omitted to be included, then we need to add to the closing stock because the closing stock is having the nature of increasing the net profit, hence we need to add. Opening stock omitted to be included, then we have to less opening stock because opening stock is having the nature of reducing the net profit. We need to give the original nature, reduce. Next ma, recovery of bad debt ma. Just now we discussed. Earlier it was allowed as deduction under section 36 subsection 1 class 7. Then at the time of recovery it is taxable under the head PGBP under section 41 subsection 4. Under other adjustments you can add. Next ma, employees contribution to RPF account. Just we have already discussed ma. It is treated as income in the hands of employer as per section 2 class 24 subclass 10. At the time of deducting from the salary of the employee, it will be treated as income in the hands of employer under section 2 class 24 subclass 10. It will be added to the income of the business income of the SSC. If it is paid within the due date, allowed as a deduction and under other adjustments ma, at the time of deduction from the salary of the employee. So we are adding ma, we are adding that amount deducted from the salary of the employee, we are adding at the time of deduction under section 2 class 24 subclass 10. If it is paid within the due date, allowed as a deduction. This is for adding to the net profit because it will be treated as business income at the time of deduction from the salary of the employee. If it is paid within the due date, allowed as a deduction. This is the pura format discussion relating to the income under the head PGBP. If you have done all these adjustments, finally you will get income under the head PGBP determined as per Income Tax Act, that can be used for payment of tax. Are you following? That is the discussion relating to the pro forma. I hope you understood well. That is the discussion. Good. Next ma, let's verify presumptive taxation ma. What is that? Presumptive taxation. It is also important. Pay attention. We are having two routes for the purpose of determination of income under the head PGBP. First one is normal income tax route. What is the first one ma? Normal income tax route. Second one, presumptive taxation route. What is the difference? I will explain. Say for example, turnover is 80 lakhs and expenditure incurred is 78 lakhs ma, assume. What is the turnover? 80 lakhs and expenditure incurred is 78 lakhs. Then what is the profit ma? 2 lakhs. This is the procedure to determine income under the head PGBP in case of normal income tax route. When it comes to presumptive taxation route, how to determine presumptive income ma? Turnover into presumptive tax rate. How to determine presumptive income under presumptive taxation route? Please tell me. Turnover into presumptive tax rate. What is the turnover ma? 80 lakhs into what is the presumptive tax rate ma? 6%, assume. Then what is the presumptive income? 4,80,000. This is the presumptive income. And this is the procedure to determine presumptive income, that is income under the head PGBP in case of presumptive taxation route. What is the difference? I will explain, pay attention. Under normal income tax route, tell me how you are going to determine income under the head PGBP ma? From turnover or gross receipts, you are reducing expenditure as a deduction, right? If you want to reduce that expenditure of 78 lakhs as deduction, you supposed to have the proof for that expenditure ma. You need to have documentary evidence for that expenditure of 78 lakhs. The documentary evidence is nothing but maintenance of books of accounts under section 44AA. Plus, in addition to having documentary evidence, that is maintenance of books of accounts, those books of accounts must be certified by the chartered accountant ma. That is nothing but tax audit under section 44AB. If these two conditions satisfied cumulatively, then department will consider that the 78 lakh rupees expenditure incurred is genuine and they will allow it as a deduction. Are you following? If department wants to allow 78 lakh expenditure as deduction, first of all, it must be proved that that expenditure is a genuine one ma. How you are going to prove it is genuine expenditure? First, you need to maintain books of accounts under section 44AA. Then it must be audited by the chartered accountant under section 44AB. If at all these two conditions satisfied, that 78 lakhs will be treated as genuine expenditure, will be allowed as a deduction, and 2 lakh will be treated as income under the head PGBP. But maintenance of books of accounts and getting them audited by a chartered accountant involves much cost ma. For maintenance of books of accounts, you have to pay some salary every month to the accountant, and to get those books of accounts audited by a chartered accountant, you need to pay tax audit fees to the CA who is conducting the tax audit. There is involvement of huge cost, and it is not bearable by the small SSC. He is a small SSC having small turnover of 80 lakhs, not possible for him to bear that expenditure. For them, lawmakers provided second route. What is the second route? Presumptive taxation route. Under presumptive taxation route, how you are going to determine presumptive income ma? Very simple. Consider gross receipts or turnover, that must be multiplied with presumptive tax route 6%. Then you will get presumptive income of 4,80,000. If at all you followed the presumptive taxation route, no need to maintain books of accounts under section 44AA, no need to get them audited by a chartered accountant under section 44AB. So, to reduce the cost burden, to remove the cost burden, to avoid the cost burden over the small SSCs, the lawmakers introduced the concept called presumptive taxation route. Understood ma? So now let's verify. That is the introduction part relating to presumptive taxation route. Let's verify one by one each presumptive provision ma. Section 44 AD, section 44 ADA, section 44 AE. 3 presumptive sections applicable at CA inter level. Let's verify. Presumptive taxation. Section 44 AD. Let's verify first of all ma. Section 44 AD subsection 1. Who is eligible SSC to claim benefit of presumptive taxation route? Let's verify. Individual or HUF or partnership firm but not LLP. Only individual, HUF, partnership firm alone eligible to go for presumptive taxation route under section 44 AD. But LLPs are not eligible, companies not eligible, cooperative societies not eligible, all remaining persons are not eligible, simply say. Must be resident ma. We are giving this benefit only to our residents. Not claiming deduction under section 80 IA, IB, IC, etc. That means income based deductions. The person, the individual, the HF, the partnership firm who wants to go for 44 AD should not claim income based deductions under chapter 6A. If they are claiming income based deductions, they are not eligible to go for presumptive taxation route. Next ma, not claiming deduction under section 10AA, SESMA, deduction to SES 10AA. They are also not eligible to claim deduction under section 44 AD. Eligible business ma, who are eligible? Any business other than, that means the following specified businesses not eligible to go for presumptive taxation route. Profession covered under section 44 AA subsection 1, because for that we are having separate presumptive section 44 ADA. That's why not covered under 44 AD. Then business covered under section 44 AE, applying, hiring, leasing of goods carriers ma. Another separate provision is there for presumptive taxation 44 AE, hence not covered here under 44 AD. Next ma, agency business, commission or brokerage business not eligible. Business having turnover of more than 200 lakhs. If at all the turnover is more than 200 lakhs, that person will be treated as, that SSC will be treated as big SSC, and he is in a position to afford what is that accountant salary with respect to maintenance of books of accounts, tax audit fee with respect to auditing the books of accounts, getting audited by the chartered accountant for those books of accounts. He is having that eligibility, is having that what we can say, he can afford that expenditure. Therefore, he is not eligible to go for presumptive taxation route. That means the SSC, individual HUF, partnership firm other than LLP, who is having business turnover less than or equal to 200 lakh alone eligible to go for presumptive taxation route. Next ma. Then how to determine presumptive income ma? 8% of total turnover or gross receipts received any other mode. That means other than specified modes, received that gross turnover, gross receipts or turnover, then we have to apply 8%. And when we have to apply 6% ma? 6% of total turnover or gross receipts received by way of account paycheck, same as 40A3. Same as 40A3. In case you received the gross receipts or turnover through the mode specified under section 40A3, same as that, then we need to apply 6%. Any other mode, 8% ma. Or income actually declared by the SSC, whichever is higher. In case the SSC wants to declare more, no one will deny that. SSC wants to declare more than the presumptive income, no one will deny that. In our earlier example, what is the presumptive income of 4,80,000? Say for example, SSC wants to declare 5 lakhs. Then 5 lakhs can be taken as a presumptive income. They will not deny, department will not deny. But when it is a problem to the department, instead of declaring 4,80,000, he wants to declare 3 lakhs ma. That means less than the presumptive income. Presumptive income is 4,80,000, but you wants to declare less than the presumptive income 3 lakhs. Then department will come with conditions. You have to maintain books of accounts as per section 44 AA and get them audited by a chartered accountant under section 44 AB if you want to declare income less than the presumptive income. But if you want to declare income more than the presumptive income, no conditions, without maintenance of books of accounts, without getting them audited by a chartered accountant, you can go for declaration of more income. No problem to the department. Next ma. Important points ma, pay attention relating to 44 AD. If the SSC after the presumptive taxation under section 44 AD, then no need to maintain books of accounts under section 44 AA and no need to get them audited by a chartered accountant under section 44 AB. Very good. Mr. X is engaged in cloth business and opted for presumptive taxation, turnover 60 lakhs ma, expenditure 58 lakhs, which is allowable under section 30 to 38. Then what is presumptive income ma? 60 lakhs into 8%, 4,80,000. No deduction will be allowed under section 30 to 38 against presumptive income. See, presumptive income 4,80,000 has been declared. That will be treated as after deemed to have been allowing all deductions eligible under section 30 to 38 ma. Again from presumptive income, no expenditure will be allowed as a deduction because that is the final income which will be taken into the total income column under the head income from PGBP. Again, no expenditure will be allowed as a deduction because all expenditures will be treated as deemed to have been allowed. Next ma. Since those deductions are deemed to have been already allowed. Next, if partnership firm opted for the presumptive taxation under section 44 AD and the firm pays any interest or remuneration to its partners, then not allowed as deduction against presumptive income. Earlier they have allowed, but through Finance Act 2016, they brought the amendment not allowed as a deduction. Interest and salary, commission, anything paid by the partnership firm to its partners not allowed as a deduction. Amendment. No depreciation will be allowed. Why, ma? Because it is, what is the dealing section with reference to depreciation? Section 32. What is assumption? All expenditures specified from section 30 to 38 are deemed to have been allowed. Hence, depreciation also not allowed. It will also be treated as deemed to have been already allowed. Next, ma. The double D of the block shall be updated accordingly. You need to update the block, ma. Even though you need to determine current depreciation, you have to reduce. You need to determine closing double DV, and that will become opening double DV for the next year. But don't claim the expenditure because deemed to have been allowed. Don't claim the depreciation. Next, ma. Disallowance under section 40, 40A, 43B will not be attracted. Why, ma? Those disallowances will be attracted only when actually you are claiming expenditure as a deduction. Here you are not actually claiming as a deduction expenditure. Deemed to have been claimed as a deduction. Simply you are applying percentage on turnover. No expenditure has been allowed as a deduction, right? Good. disallowance under section 40, 40A, 43B will not be attracted. Why will not be attracted, ma? Because you can disallow only when the expenditure is actually claimed as a deduction. Here you have not claimed any expenditure actually as deduction. There is no question of disallowance. Next, ma. Advanced tax provisions are applicable for business covered under section 44AD from previous year 16-17. Before that previous year, ma, advanced tax provisions are not applicable. They can make the entire tax payment by way of self-assessment tax. But after amendment brought out through Finance Act 2016, applicable from previous year 16-17, they are liable to pay advance tax in one installment. Let's verify. Has to pay in one installment on or before 5th March of the financial year. Otherwise, they are liable to pay interest under section 234B, 234C. Next, ma. Chapter 6A deductions will be allowed against presumptive income. Comfortably, you can claim Chapter 6A deductions against presumptive income. Which deductions, ma? Expenditure-based deductions. Because if at all you are eligible to claim income-based deductions, you are not at all eligible to go for presumptive taxation route. So, what are the deductions we can claim under Chapter 6A? Expenditure-based deductions. Next, ma. Losses can be adjusted against presumptive income. Comfortably, losses you can adjust under section 70 to 80 against presumptive income, no problem. Unabsorbed depreciation, ma. What is the dealing section with reference to unabsorbed depreciation? 32 subsection 2. That is covered within the ambit of 30 to 38. Demutte have been already allowed. Again, not allowed as a deduction. Remember, unabsorbed depreciation under section 32 subsection 2 will not be allowed against presumptive income. Since all deductions under section 30 to 38 are deemed to have been allowed. Very good. If the SSC wants to declare income less than the presumptive income, this is the point. If he wants to declare less than the presumptive income, then they have to maintain books of accounts under section 44AA and get them audited by a chartered accountant under section 44AB. I have already explained. Next, ma, new insertion of subsection 4 under section 44AD. 44AD subsection 4. What it says? From the previous year 16-17. If at all you opted for presumptive taxation under section 44AD subsection 1, then subsequent next 5 years you have to follow the presumptive taxation route. You need to opt for presumptive taxation route on a mandatory basis. In case within next 5 years, any 1 year, you opted normal income tax route. That means you declared income less than the presumptive income. Then from next to 5 years, you are not eligible to go for presumptive taxation route as per 44 AD subsection 4. That means you need to maintain books of accounts under section 44 AB and get them audited by a chartered accountant under section 44 AB as per section 44 AD subsection 5, provided your taxable income is exceeding basic exemption limit. That's it. Let's verify. If the SSC declared the income under presumptive taxation route for any previous year from previous year 16-17, then he has to declare the income under same presumptive taxation route for 5 previous years succeeding to such a previous year. Say for example, in the previous year 21-22, you opted for presumptive taxation route. Then from previous year 22 to 23, 5 continuous years you have to go for presumptive taxation route. That is for next 5 previous years. If such SSC declared the income under normal taxation route, that means you want to declare income less than the presumptive taxation in the next 5 years. For any previous year within such 5 succeeding previous years, then 44 AD subsection 4 is applicable within such next 5 years. Then what happens? As per section 44 AD subsection 4, such SSC is not eligible for opting for presumptive taxation route under section 44 AD subsection 1 for 5 previous years succeeding to the previous year in which the SSC computed his income under normal income tax route. That is, for the next 5 years, he has to go for, what is that? Normal income tax route, maintain books of accounts under section 44 AA and get them audited by a chartered accountant under section 44 AB as per section 44 AD subsection 4. Next, ma. That means such SSC has to follow normal income tax route. That is turnover minus expenditure for such 5 succeeding previous years, even though the turnover does not exceed 2 crore. That is punishment actually. The SSC who is covered under section 44 AD has to, subsection 4 has to maintain books of accounts under section 44 AA and get them audited by a chartered accountant under section 44 AB as per section 44 AD subsection 5. That subsection 5 says that if you are covered under 44 AD subsection 4, maintain books of accounts as per section 44 AA, get them audited by a chartered accountant under section 44 AB, provided the total income or taxable income exceeded basic exemption limit. In case your total income or taxable income not exceeded BEL, no need to go for maintenance of books of accounts, no need to get them audited by a chartered accountant. 44 ADA, very simple, let's verify. This is applicable for profession, notified profession. Eligible SSC, individual or partnership firm but not LLP who is engaged in the notified profession specified under section 44 AA subsection 1, who are covered. What is the notified profession? I will explain little bit later. And he must be the resident, same. Notified profession, legal, medical, engineering, architect, accountancy, technical consultancy, interior decorator, and any other profession notified by the CBDT in official gazette. Then what is the gross receipts limit? 50 lakhs. Let's verify. Gross receipts from such notified profession shall not exceed 50 lakhs in the current previous year. In case it is exceeding 50 lakhs, then you are not eligible to opt for 44 ADA. You have to go for normal income tax route, maintain books of accounts under section 44 AA, get them audited by a chartered accountant under section 44 AB. Very important. Presumptive income, highest of the following: 50% of the total gross receipts or income actually declared by the SSC, whichever is higher. In case of 44 AD, 6% or 8%, but 44 ADA 50% huge. Or income declared by the SSC, whichever is higher. Next, important points, same as above actually. All deductions under section 30 to 38 shall be deemed to have been already allowed. Again, actually not allowed. Good. If partnership firm opted for the presumptive taxation under section 44 ADA and firm pays any interest or remuneration to its partners, then it is not allowed as deduction against presumptive income. Good. Depreciation under section 32 shall not be allowed because deemed to have been already allowed. The black value shall be updated accordingly. We have already discussed. In case the SSC wants to declare income less than the presumptive income, then such SSC has to maintain presumptive income 50 lakhs. Say for example, the gross receipts are 40 lakhs, then 40 lakhs into 50%. What is presumptive income? 20 lakhs. But SSC wants to declare 15 lakhs, that means income less than the presumptive income. Then he has to go for maintenance of books of accounts under section 44 AA and get them audited by a chartered accountant under section 44 AB, provided his income exceeds, taxable income exceeds basic exemption limit. Advanced tax provisions are applicable, but one installment on or before 15th March financial year, 15th March of the financial year. If not paid, you are liable to pay interest under section 234B and 234C. Next, presumptive taxation 44 AE, very important, pay attention. Eligible SSC, any SSC who is engaged in the business of flying, hiring, leasing of goods carriers or carriages, such SSC should not own more than 10 vehicles at any time during the current previous year. What is the limit, Here the limit is with respect to vehicles, that SSC should not own more than 10 vehicles at any time during the current previous year. Even single day during the current previous year, more than 10 vehicles held by the SSC, owned by the SSC, then he is not eligible to go for presumptive taxation route under section 44 AE. Either 9 vehicles or 10 vehicles, not more than that. Up to 10, equal to 10 or less than 10. Next, presumptive income, highest of the following. How to determine presumptive income? Pay attention. In case of heavy good vehicle, 1000 rupees per ton of gross vehicle weight or unladen weight for the month or part of the month. For full month or part of the month, 1000 rupees per ton for gross vehicle weight or unladen weight, In case of any other heavy good vehicle, any vehicle other than heavy good vehicle, 7,500 rupees per month or part of the month for each vehicle. We need to consider, or income actually declared, whichever is higher, While determining number of months, we have to consider the period for which such vehicles are owned by the SSC. That means, in the examination, they will give one particular vehicle purchased by the SSC in the month of April, but put to use only from the month of January. That means owned for 12 months, but put to use only for 3 months. Then we have to multiply, in case it is other than heavy good vehicle, we have to multiply that vehicle into 7,500 with 3 months or 12 months, 12 months. Because the period for which it is actually used having no relevance, but the period for which it is actually owned by the SSC is having relevance. Vehicle purchased by way of hire purchase shall be taken into the consideration even though he is not holding the legal ownership. Note 3, in case the SSC wants to declare income less than the presumptive income, same concept, maintain books of accounts under section 44 AA, get them audited by a chartered accountant under section 44 AB. Next, common points, 44 AD and A, 44 ADA and 44 AE. If SSC opted for presumptive taxation under these sections, no need to maintain books of accounts under section 44 AA and no need to get them audited by a chartered accountant under section 44 AB. We know no deductions will be allowed. We know. If partnership firm opted for presumptive taxation under these sections and firms pays any interest to its partners, then it is allowed as deduction against presumptive income. This is not relevant. From presumptive income, tell me how to determine income under the head PGBP. If at all the partnership firm is paying interest and remuneration to the partners, let's verify. Start from presumptive income, less interest paid to the partners, then you will get book profits as per section 40 class B. From book profits, reduce remuneration allowed under section 40 class B. We are having computations, right, to determine remuneration allowable under section 40 class B. Apply those computations, then you will get taxable income of the firm. Depreciation shall not be allowed, we know. Disallowances will not be attracted. Advance tax provisions are applicable. 4 installments you have to pay. Next, chapter 6 deductions will be allowed against presumptive income, we know. Losses can be adjusted against presumptive income, 70 to 80. Unabsorbed depreciation not allowed. If the assessee wants to declare income less than the presumptive income, then they have to maintain books of accounts under section 44AA and get them audited by a chartered accountant under section 44AB. That is regarding income from PGBP. Let's verify one illustration on depreciation for your better understanding. If at all depreciation computation has been given in the examination, you should be in a position to compute the depreciation without any hurdles. For that, I'm explaining, pay attention. Mr. X, a proprietor engaged in manufacturing business. He is engaged in manufacturing business. That means if at all he purchased any new plant and machinery eligible for claiming additional depreciation under section 32 subsection 1 class 2A. Remember, furnishes the following particulars. Opening balance of plant and machinery less than 1/4/2021 30 lakhs. New plant and machinery purchased and put to use on 8/6/2021 20 lakhs. 8/6/2021 means greater than 180 days eligible for normal depreciation. New plant and machinery acquired and put to use on 15/12/2021 8 lakhs. It is put to use less than 180 days eligible for reduced depreciation. Acquired in the current previous year and put to use less than 180 days in the current previous year eligible for reduced depreciation. Computer acquired and installed in the office premises on 2nd January 2022 3 lakhs. Plant and machinery rate of depreciation applicable 15%, computer applicable 40%. If you remember, compute the amount of depreciation and additional depreciation as per the Income Tax Act 1961 for the assessment year 22-23. Assume that all the assets were purchased by way of account paycheck. That means it is eligible for claiming depreciation. Chalo, let's verify solution. I'm explaining solution in a very easiest way. Pay attention. If at all you understood this procedure, it is very easy for you to compute depreciation for any problem. Chalo. Illustration 1. Computation of depreciable value or value for claiming the depreciation in the hands of Mr. X. Particulars. Block 1, block 2. 2 blocks we are having. What do you mean by block of assets definition? Group of assets falling under same category, having same class and having same rate of depreciation. So here we are having 2 rates of depreciation, hence divided into 2 blocks. Plant and machinery 15%. Second one also plant and machinery, but computer 40%. Opening double DV as on 1/4/21 30 lakhs. Additions during the year purchase of new plant and machinery on 8/6/2021 more than 180 days eligible for normal depreciation 20 lakhs, and purchase of new plant and machinery on 15/12/2021 less than 180 days eligible for reduced depreciation. Remember, less sale proceeds any sale proceeds we are having in the first block? No. Now let's go for block 2. Opening double DV nil. Additions we are having because that block has been created in the current previous year because of purchase of computer on 2nd January 2022 less than 180 days. What is the value? 3 lakhs. Sale proceeds nothing. Then what is the depreciable value or value for claiming depreciation? 58 lakhs and 3 lakhs. First of all, let us determine depreciation for block 1. Thereafter we can go for block 2. Pay attention. Computation of depreciation allowable under section 32 subsection 1 class 2 on plant and machinery. Verify the procedure. First of all, consider depreciable value. Total depreciable value how much? 58 lakhs. That must be divided into 2 categories. First category, value of the plant and machinery acquired during the current previous year. Category 1 belongs to value of plant and machinery acquired during the current previous year. Out of total depreciable value 58 lakhs, first of all, we need to give preference to the plant and machineries which are acquired in the current previous year. Value of plant and machinery acquired during the current previous year, how much? 28 lakhs. Then out of 58 lakhs, if we reduce 28 lakhs, what is the balance amount? 30 lakhs. That is relating to value of plant and machinery acquired in the earlier previous years. That is relating to the value of the plant and machinery acquired in the earlier previous years. 30 lakhs. That should be always balancing figure. That is always be balancing figure. Remember. Okay. Remember the point. Category 2 is always eligible for normal depreciation. Why, ma? Because that value belongs to the plant and machinery acquired in the earlier previous year. The plant and machineries which are acquired in the earlier previous years are always eligible for normal depreciation. Category 2 always apply normal depreciation. How much, ma? 30 lakhs into 15%, 4,50,000. Now come to category 1. Out of that value of assets acquired, plant and machinery acquired in the current previous year, we need to again further divide it into two categories. Put to used more than 180 days, put to used less than or equal to 180 days. Let's verify. More than or equal to. Value eligible for normal depreciation more than or equal to 180 days, 20 lakhs, ma. Less than 180 days, 8 lakhs. If it is happen to be more than or equal to 180 days, eligible for normal depreciation. Less than 180 days, ma. Reduced depreciation. Already we verified. Then how much it is? Normal depreciation 20 lakhs into 15%, 3 lakhs. Then reduced depreciation 8 lakhs into 15% into 50%. How much it is? 60,000. Successfully we determined the normal depreciation as well as reduced depreciation. Now let's go for additional depreciation. That assessee is engaged into the manufacturing activities and purchased the new plant and machinery and installed in the current previous year, hence eligible to claim the additional depreciation under section 32 subsection 1 class 2A. Let's verify. Computation of additional depreciation allowable under section 32 subsection class 2A on plant and machinery. Value eligible for additional depreciation value 28 lakhs, ma. Acquired during the current previous year. Out of that, put to used more than or equal to 180 days, 20 lakhs. Less than 180 days, 8 lakhs. More than or equal to 180 days, eligible for full rate of additional depreciation. 20 lakhs into 20%, 4 lakhs. Less than 180 days, ma. Proviso 2 to section 32 subsection 1 class 2 is applicable. 8 lakhs into 20% into 50%. How much it is? 80,000. Then remaining 50% will be allowed in the next year as per proviso 3. We know. Total depreciation equal to normal depreciation plus reduced depreciation plus additional depreciation. How much, ma? 7,50,000 plus 60,000 plus 4,80,000. 12,90,000. Successfully we completed the depreciation relating to category 1. Now let's go for category 2. Second block, ma. Second block. Computer, right? What is the rate of depreciation on computer? 40%. It is put to used more than or equal to 180 days, ma. Less than 180 days. Let's verify. Reduced depreciation less than 180 days. 3 lakhs into 40% into 50%. Half. 60,000. Tell me whether that computer is eligible for claiming additional depreciation under section 32 subsection 1 class 2A, ma. No. Why? Because it is a computer. We need to consider that it has been installed in the office premises. Say for example, in the question they given that it is installed in the factory premises, then you have to claim additional depreciation. No specification has been made. Reasonable assumption, it is installed in the office premises, not eligible for claiming additional depreciation. Here computer is not eligible for additional depreciation under section 32 subsection 1 class 2A since it is installed in the office premises. Given in the question, ma. Okay, then no problem. As per the proviso 3 to section 32 subsection 1 class 2, the balance reduced depreciation at the rate 10% shall be allowed in the assessment year 23-24. Very good. So that is the discussion relating to one problem on depreciation. I hope you understood well. Thank you.